So one, we do see that equity valuations are pretty high across the board, but not evenly though. We still see value stocks out there with very reasonable valuations, but we also see, especially in the tech sector, very high valuations that require high expectations in order to justify themselves. For example, but that's kind of a slower rollout of that money. It's not like an adrenaline of getting a stimulus check into the market. And so I think that rate of change is probably slowing down, but that I think longer term, the inflation rate will probably still be above interest rates you can get on bank cash or sovereign bonds like treasuries. Yeah, so I think Powell kind of set the stage last year at Jackson Hole by kind of, pointing out their shifting emphasis. So for the past 40 years or so, ever since Volcker raised rates and turned us from a structurally inflation to a disinflation period for 40 years, they've been kind of emphasizing inflation over unemployment, where they have two mandates that they balance, and they've been treating a 2% inflation target, especially in the past decade or so, more like a ceiling. Whereas going forward, they want to emphasize that unemployment is in their view probably more important, especially when you go down into not just one employment figure, but employment among different demographics, employment among different income levels, wider measures of unemployment like underemployment, marginal employment, things like that, and that they're willing to let inflation run hot for periods of time, for example. But that's kind of a slower rollout of that money. It's not like an adrenaline of getting a stimulus check into the market. And so I think that rate of change is probably slowing down, but that I think longer term, the inflation rate will probably still be above interest rates you can get on bank cash or sovereign bonds like treasuries. And so there's, that it's a high enough inflation rate to basically still be a devaluation effect on your currency over time. And then in addition, this kind of round of inflation we saw happened without oil prices going high in their view. I also think that if you take a step back and look at history, where we are in the long-term debt cycle, many countries don't really have much of a choice other than to run kind of persistently negative real rates for at least their short-term treasuries, even their long-term treasuries. And that's the part that they can't really say out loud, too much. So instead, it's focusing on that unemployment figure. I think kind of emphasizing that more so than the inflation figure. And so
Right.
historically, most of the big inflationary pulses are from higher oil prices, or at least that's a big component, because it's by far, compared to every other commodity combined, oil is a much bigger market, and it impacts everything from transportation to manufacturing to energy costs, all sorts of things. And so this whole thing happened with oil just kind of returning to where it was pre-pandemic. But we've also had, for example, companies around the world have reduced their oil capex. And so, supply is a little bit more limited. And so going forward, as these emerging markets, for example, which are now the biggest sources of oil demand, as they come out of these lockdowns, as they come out of the pandemics, as their oil demand kind of trajectory comes back online. So one, we do see that equity valuations are pretty high across the board, but not evenly though. We still see value stocks out there with very reasonable valuations, but we also see, especially in the tech sector, very high valuations that require high expectations in order to justify themselves. At the same time, we see households have record high equity allocations. And some of that's simply because the equities appreciated in price, but it's also because they look at their cash and bonds that are yielding below the inflation rate, and they say, well, I got to own some equities. And so they're kind of piled pretty heavy into the equity side of the portfolio. We've also, of course, we had the meme stock phenomenon, the trading phenomenon. That's to some extent that's also spilled over into crypto, obviously. And so there has been a lot of kind of risk-taking behavior, as you've seen, the Federal Reserve be as dovish as they have been. And so that was one of them. Another one was the 30s, because you had, the Treasury was a certain amount of dollars, and the dollars was a certain amount of gold. And then they changed how much gold the dollars were worth. And so the 70s were another version of that, where they just took away the whole gold tie altogether. And so I do view those as defaults. The kind of the big difference was that in the 70s, even though you had a default, debt as a percentage of GDP was low, both for public balance sheets and for private balance sheets. So in there, the issue was not that debt to GDP was high, it was that debt compared to the gold reserves were high. So now that the Federal Reserve is talking about the possibility of tapering, now that valuations are this high, I think that there are a number of investors out there that are concerned about risk, right? So obviously in recent months, we've had the Delta variant kind of on the headlines for a while. It's been hitting Southeast Asia for a while in particular, so it's been slowing down that growth engine. It's also been hitting China, and China is in the middle of a contracting credit cycle as well, which a lot of charts show that with a multi-month lag after China goes through kind of a credit contraction, usually you have global PMIs and other kind of measures of acceleration kind of roll over as well. So basically, the whole fault, the shortcoming of the Bretton Woods system is that from the beginning of that system, you saw gold reserves slowly go down, and the claims on those gold reserves, so basically treasuries and dollars, especially the ones that are owed by international creditors, because at that point, for Americans, gold was dollars were no longer redeemable for gold, but for those foreign international creditors, it was still redeemable. And so I would say a lot of economic indicators look like they're decelerating, meaning that most of them are still growing, but at a slower pace than they were in a year-over-year basis. Some of them are outright contracting, like retail spending. Fiscal stimulus is kind of in the rear-view mirror now, right? So there were these multiple rounds of stimulus checks and extra unemployment benefits, and those are behind us, or in some cases still rolling off. I think we could see kind of persistently higher oil prices in the years ahead. It'll have ups and downs, but I think that we've been in this kind of 13-year oil bear market, and I think that say the next 5 years, next 10 years could be a lot more positive for that market than this past period, and that would be a generally more pro-inflationary environment, especially when you compare it to how low yields are on bank accounts and treasuries. And so there's kind of fewer reasons to be optimistic. Now we still could get another leg up, for example, but it's basically the market has already squeezed a lot of juice out of this run. As you point out, I mean, we made tons of new highs this year. If I remember correctly, I think we've gone like 10 months without a 5% pullback, which is a very long stretch of time. And so basically, the idea of something like gold or Bitcoin or these other kind of hard assets is that in an environment of negative real yield, those harder assets generally hold up pretty well compared to holding large amounts of fiat currency. Now, fiat currency can still be useful tactically. You can still use it to pay your short-term obligations, but in general, you wouldn't want to hold it for many years for a large percentage of your assets. And so, there is, I think, some buyer exhaustion out there. And so when you do see that margin go down, historically, that sometimes it's been the beginning of a very major decline, like in 2000 and 2007, for example. Other times it can trigger, easily a 10% correction or more, as some steam is let out of the market and some of the valuations reset themselves. So it's hard you have to be a trader to really kind of, capitalize on those movements. But I do think that from a long-term investor standpoint, this is certainly an environment where you want to be very, very careful with the amount of money, the valuations you pay for companies you like.